Hello everyone, welcome to today's US Open live webinar. I'm your host Nikos Zabouras, Senior Market Specialist at FXCM. It is Thursday, August 3rd, 10 minutes before Wall Street opens as always. And we have another packed session today. Just earlier, the Bank of England raised rates again, but it was a smaller hike and there was a three-way vote split, which along with the typical absence of forward guidance sustains the uncertainty around the outlook. On the other big news since our last session is that US rating agency Fitch downgraded the United States, and Wall Street is weighed after that fact. But now focus shifts to big tech earnings and the NFPs, which are due tomorrow. These are some of the things we will be talking about today. But first, please read carefully through the risk warnings and the disclaimers, and then we will get started. Once again, please go over the disclaimers and the risk warnings, and also bear in mind that anything discussed here does not constitute investment advice and should not be construed as such. Okay, let's get the ball rolling. As I said, we have quite a few things to talk about. Let's start directly with GBP USD. Since earlier we had the Bank of England opting for a smaller 0.25% hike after June's reacceleration in a three-way split decision. It did not offer forward guidance, but it's hard to see the end given that inflation is not expected to fall below the 2% target for another couple of years. But on the other hand, there are concerns around the economy, around the housing market, around rising mortgage costs in the UK, which means that officials may want to trade with caution. So GBP's reaction was limited because the move was not a surprise, but the small hike and the lack of guidance do put pressure on the GBP USD, some pressure as we can see on the chart, at least initially. Now with more hikes in play, the pair could rise, but risks that the BoE may break something means that further tightening may not necessarily be that beneficial for the British pound. Now, we can see, however, that the pair defends the daily Ichimoku cloud, while the relative strength index is in oversold territory. As such, the pair may find the opportunity to reclaim the 200 period EMA, the black line, but does not inspire confidence for moves past 1.3. Now, at this stage, immediate bias is on the downside since we are below the 200 period exponential moving average I referenced. But the truth is that given what we said about the RSI and the daily Ichimoku cloud, fresh catalyst may be needed for the 200 period, the 200 days exponential moving average to come into to be challenged and to be breached. So that's it with GBP USD. let's move over to Euro USD, and then we will also talk about the New Zealand dollar, because we had some news there as well. And then, of course, we'll move to the Wall Street with SPX 500, and then we'll talk about what's ahead. Now, on the Euro USD front, not much has changed since our previous session. The pair is in a precarious position after the ECB opened the door to a September pause and is vulnerable to the 200 period, 200 days EMA at around 1.078, but we are cautious around further weakness towards and beyond 1.0634. The ECB may still have a hard time holding rates, let alone ending the tightening cycle, given that inflation is far from target and core readings particularly sticky. The Fed has covered much more ground, and markets believe it is done hiking. However, the strong economy and the hot labor market means that it may be need to do more, and so the NFPs tomorrow will be very important. We will talk about it at the end of our session. Now, the relative strength index is close to oversold territory, and as we said the last time, the current region up until the 200 days EMA we referenced can contain the fall and give it a chance to rebound, but strong catalysts will be needed for recovery towards 1.1276. But we can definitely see a return above the 200 period EMA, which is located at around 1.1. Now let's go to the Kiwi, the New Zealand dollar versus the US dollar. Wednesday's labor report from New Zealand showed signs of cooling. Unemployment rose to 3.6% and the highest in 2 years. Participation rate increased to historic highs, which can actually help lower the temperature of the labor market and bring it into better balance. The RBNZ, the central bank, had kept rates unchanged in July after 12 straight hikes worth 5 to 5 basis points, and its projections imply that the terminal rate has been reached. Now, this data, along with easing inflation, could keep policymakers in the sidelines again. NZD-USD dropped as a result, and there is a risk for fresh 2023 lows, which are located at 0.5984, although sustained weakness towards and beyond 0.59 has a higher degree of difficulty. On the other hand, the labor market in New Zealand is still tight and wage costs stayed at historical highs, while inflation is far from the 1 to 3% target. And this creates the need for more monetary restraint. From a technical perspective, the fall looks stretched, and we could see a recovery effort towards the 200 period EMA at around 1.0619, but the QE does not inspire confidence for a convincing report return around this region, let alone challenging the next major resistance, which is in this region here, 0.641. And with that said, we're still almost a minute out of the US Open, but let's turn our focus over to SPX 500. Here we are. So sentiment soured in Wall Street after Fitch downgraded the US long-term foreign currency issued default rating to AA+ from AAA, reflecting an expected fiscal deterioration over the next 3 years. SPX 500 posted one of its worst days of the year as a result, and there is now a risk of sub 200 period EMA moves that would endanger the bullish bias and expose the index to the daily Ichimoku cloud, but the downside, I would say, looks well protected in this region here. Now, it is probably difficult to see the downgrade, this downgrade from Fitch having a lasting impact, as corporate America appears to not to share the views of Fitch, and there are other more important factors, I think, at play. We have big tech earnings from Apple and Amazon tonight, and in general, big tech earnings and the IA boom have carried Wall Street higher this year. And then the NFPs follow on Friday, all of which could determine the SPX 500 trajectory. Above the 200 period EMA, bulls are in the driver's seat and can set fresh 2023 highs, tackling 4,064, but record highs look distance, located at 4,820. And that's pretty much it from the technicals. Let's round things off as always with what's ahead. We have the US jobs report on Friday. The United States had added 209K jobs in June, which is the first downside surprise of the year and the smallest addition since the last loss of jobs in December 2020. This shows some cooling in the labor market, but it remains strong since the unemployment had ticked down and remains close to the 5 decades lows, while wages are elevated. Now, this calls for sustained restrictive stance and will be closely watched by the Fed. All banks, the Fed included, have touted data dependency, so every bit of data we get until the September meeting will definitely be important. And we remind you that Chair Powell had opened the door to both outcomes, either a hike or a pause at the next meeting in September. Next week is off to a slow start, but things heat up in the second half with inflation updates from China and the US. Of course, we will have the chance to talk about all of that in our next sessions. And as I said, there are also earnings tonight, Apple and Amazon, and then focus at the beginning of the next week shifts to EV startups, Lucid, Lioto, and Rivian. That's it from me for today. Thank you for joining me.